Common myths about financial statement analysis. Good day everyone. Welcome to the Isle of Knowledge, where we evaluate a variety of important topics. Today, we'll look at some common misconceptions about financial statement analysis. Before delving into the specifics of today's topic, let's review the basic definitions of the key terms used in this presentation. Financial statement analysis is the process of reviewing and analyzing a company's financial information in order to make informed economic decisions. A company's financial statements record vital financial data on the financial transaction carried out by the company over a specific period of time. There are various types of financial statements that are used to record different aspects of a business's operations. A balance sheet, profit and loss statements, shareholder equity statements, and cash flow statements are common examples of these statements. To record and maintain financial data, these financial statements adhere to some accounting principles. The most common one being IFRS. Depending on the company, the financial analysis methodology may vary. Vertical analysis, horizontal analysis, and ratio analysis are three of the most common financial analysis techniques used to evaluate financial statements. On the other hand, there are numerous myths, misconceptions, and limitations associated with financial statement analysis. Some analysts rely too heavily on financial statement analysis, without understanding its limitations. If the recent accounting scandals have taught us anything, it is that financial statements are subject to manipulations. Some of them are tolerable, while others are inappropriate, and possibly illegal. Let's have a look on some of the common misconceptions of financial statements analysis. One of the key misconceptions is that a financial statement audited by a reputable auditor, and containing an unqualified auditor's opinion, is reliable. However, the truth is that audited statements prepared by large auditing firms do not guarantee their accuracy. More often than not, audited financial statements are manipulated in one way or the other. If the bankruptcy of the Lehman Brothers taught us anything, it is that audited financial statements are not always completely reliable. The fact that a company is publicly traded, and its financial statements are easily accessible does not guarantee that the company's financial statements are reliable and trustworthy. Another popular misconception is that credit limits for customers should be determined based on the analysis of financial statements. Financial statement analysis is a vital part of broader risk assessment process. Historical financial statements do not reveal the company's future prospects, the results of its R&D expenditures, new product introductions, new marketing campaigns, new pricing strategies, or the customer's recent decision to enter or exit a specific market segment. Past financial data, whether positive or negative, is not a reliable indicator of a company's future performance. Therefore, setting credit limits based on prior financial data may not be a good idea. Importantly, financial statements that are out of date are even less reliable as a risk assessment tool. Another common misconception is that unaudited financial statements are preferable to no financials at all. The fact of the matter is that unaudited financial statements could be worse than nothing. They may contain false and misleading information, violate accounting rules, or even be completely fraudulent. Since there is little chance that the credit reviewer will be able to independently confirm their accuracy, unaudited financial statements should actually be taken with a bucket of salt, rather than a grain of salt. Therefore, it is prudent not to place too much reliance on them when assessing credit risk. Another common misconception is that comparing individual customer performance to industry benchmarks is an effective way to compare and contrast customer performance. However, industry norms are typically calculated using financial data from listed companies that is either publicly available or provided to credit bureaus. Therefore, those benchmarks do not account for the vast majority of businesses in any given sector. Another misconception is that the quick ratio is an accurate indicator of a company's liquidity. The quick ratio, as opposed to the current ratio, is a more sensitive measure of liquidity. However, liquidity is more or less a question of timing. If liabilities are required to be paid before assets can be converted to cash, the company may be in trouble. Furthermore, just because a company has the ability or cash to pay its creditors on time, does not guarantee that the customer will do so. Ability and willingness are two different things. Willful defaulters are notorious not because they don't have the means to pay their debts, but because they don't want to honor their commitments. Another popular misconception is that financial statements possess almost everything required for the financial analysis. Analysts routinely request, receive, and review the balance sheet, income statement, change in equity, and cash flow statements, believing that these four statements capture nearly everything about a company's financials. Unless the analyst receives and reads relevant notes to the financials, they will miss out on important risk management information. Contingent liabilities are one of the most common items that analysts frequently overlook. A contingent liability is a potential claim against a company, in which the company's actual or direct liabilities depend on some future event or circumstance. A lawsuit filed against a company is a classic example of contingent liability. Because the company is unsure about the outcome of the case, it does not report the amount demanded by the plaintiff as a liability. Product warranties and letters of guarantees are also popular items that fall under contingent liabilities. From the standpoint of the company, this is perfectly reasonable and correct. However, from the perspective of a credit professional evaluating the risk, this could be an important piece of information. A person who reviews financials should always request notes to financial statements and read these notes thoroughly. If the analyst has any questions or concerns, he or she should request more information about contingent liabilities. Financial statement analysis is, unquestionably, a critical step in evaluating and assessing an organization's financial health. It provides deeper insights into past operations, and may even assist in forecasting the company's future performances. However, users must be aware of the constraints of financial statement analysis before relying too heavily on it. Otherwise, the cost of making a wrong decision based on faulty assumptions will be enormous. Thank you for watching. Please consider subscribing, liking, and sharing, which means a lot to me. I love to see your thoughts in the comment section.